Welcome back to The Explainer. So today we're diving into this quiet revolution that's happening in real estate. Seriously, it's a shift that's so fundamental, it's totally changing the game for what makes a skyscraper in New York or, an office park in Silicon Valley a good investment. And it all boils down to just three letters: ESG. I mean, for decades, if you asked this, the answer was always super simple, right? It was all about location, location, location. Maybe how big it was, the square footage, maybe the quality of the lobby. But here's the thing. In today's market, that old school answer, well, it's not just incomplete, it's becoming downright dangerous. And that's because there's this whole new set of factors coming into play, and they're creating this really clear dividing line. You've got the buildings that are going to thrive for the next few decades, and then you've got the ones that are seriously at risk of just becoming obsolete. And that new standard? It's ESG. Yep. Environmental, social, and governance. These criteria have totally broken out of the niche world of sustainability reports. Now, they are a fundamental, absolutely non-negotiable driver of market value in commercial real estate. It's a whole new ballgame. All right, so let's really get into this, because I want to be clear, this is not just another trend. What we're talking about is a seismic rewiring of how the entire industry works, literally from the ground up. And look, this whole transformation, it's not just happening by chance. No way. It's being pushed forward by three massive, interconnected, and, let's be honest, pretty much unstoppable forces. And this chart, it shows the dynamic perfectly. The pressure is coming from all sides, you guys. You've got the capital markets, the folks with the money. Then there's tenant demand, the actual companies that use the space. And of course, you've got regulations, governments laying down the new rules of the game. So first up, let's follow the money. We're talking about huge institutional investors, like pension funds. They now have these super strict ESG mandates. It's not a suggestion. They have to put their money into sustainable assets. So what does that mean? Well, it means if your building doesn't cut it, you could find it really, really hard to get any financing. And get this, here's the proof, right here in the numbers. That BPS you see, that stands for basis points. And a 10 to 25 basis point discount on a massive real estate loan, that is significant. It's simple. Buildings that can prove they're green get access to cheaper money. It's a straight-up financial reward for doing the right thing. Okay, so force number 2, the tenants. Think about it. All these big corporations have their own public ESG goals they have to hit now, and a huge part of that is the environmental footprint of the offices they lease. So what's happening? We're seeing this massive flight to quality, where companies are literally ditching their old, inefficient buildings for modern, green-certified spaces. And a third big one, the government. You've got laws popping up like New York City's Local Law 97. This law isn't messing around. It slaps massive fines on buildings that don't meet strict energy targets. This isn't a friendly suggestion. It's a huge financial penalty for not getting with the program. And we're seeing rules just like this appear in cities all over the globe. Okay, so we get why it's happening, right? The pressure is on from every single angle. But what are we actually talking about when we say E, S, and G? Let's break them down. All right, first up is E for environmental. This is probably the one you've heard the most about. It covers all the big stuff, from how much energy a building uses and its carbon footprint, all the way to how well it can stand up to the physical risks of climate change. Now this is where it gets really interesting. Notice how risk is split in two here. You've got your physical risks. That's the stuff you see on the news, right? Floods, wildfires, all that. But then there's transition risks. These are the financial threats that pop up as we all move to a low-carbon world. Think new carbon taxes or a sudden regulation that makes your perfectly good old buildings suddenly non-compliant. Both of these, absolutely devastating to a property's value. Okay, let's talk about the S for social. Now, this one's often overlooked, but man, it is gaining importance fast. This is all about the building's impact on people, on human beings, from the health and wellness of the tenants working inside to how it interacts with the community around it. It really just asks a simple question. Does this building actually make people's lives better? And we're not just talking about meeting basic safety codes here. No, this goes way beyond that. We're talking about things you can actually measure that affect people's well-being, like top-of-the-line air filtration systems, which, became a massive deal after 2020, or designing a building to let in as much natural light as possible to boost mood and productivity. And it doesn't stop at the front door. It's also about how the building fits into the neighborhood. Does it create local jobs? Is it easy to get to by public transit? And that brings us to the final letter, G for governance. Think of this as looking under the hood. It zooms out from the building itself to the company that owns it. I mean, you could have the greenest, most amazing building on earth, but if the company running it is shady, investors are going to run for the hills. It's all about accountability. Is the company transparent? Is it ethical? Is it responsible? And the key thing to get here is that this isn't just about making nice promises. It's all about measurable actions. It's about transparent reporting on your ESG data, verified by someone else. It's about having actual experts on your board who know what they're talking about. And this is a big one, it can even mean tying executive bonuses directly to hitting these sustainability goals. It's really about putting your money where your mouth is. All right, so we've covered the what and the why. But now for the big question. How does a real estate owner with, a giant portfolio of buildings actually turn all this theory into a practical strategy that makes money? Well, it's a really disciplined top-down approach. You start at the very top at the company level, setting clear goals. Then you zoom in a bit to the whole portfolio, figuring out which of your buildings have the biggest risks and the biggest opportunities. And only then do you get down to the nitty-gritty at each individual building, doing things like putting in a new super efficient HVAC system or installing smart lighting. So this is the million-dollar question, isn't it? After all this work, all this effort, what does it actually mean for the bottom line? Does being green actually translate into more, green? The answer is a resounding yes. The data here is crystal clear. Across the entire market, buildings that are certified green consistently get higher rents. We're talking 3 to 7% higher. Now, on a huge multi-million-dollar property, that is a massive chunk of change, a huge boost to income. And this chart just nails the new reality. Look, it's not just about green buildings earning more money. The real story here, the thing you need to pay attention to, is that brown discount. Buildings that don't keep up are now being actively punished in the market. They're selling for less than comparable standard buildings. Suddenly, doing nothing has a very real, very direct cost. And really, that brings us right to the main takeaway here. ESG isn't some side project anymore. It's not a nice to have for the annual report. It is now a fundamental, core part of the business of real estate. It's absolutely essential for managing risk and for creating value, from the day you buy a building to the day you sell it. So I'll leave you with this final thought. As these standards just become, standard for investors, for tenants, for regulators, are we heading towards a future where we don't even need the term green building anymore, where they're just buildings, and the only ones we point out are the ones that didn't make the cut and got left behind?